My name is Scott Green, Marketing Director with Regal Securities, and shortly I'll be introducing our main presenter, Joseph Burgoyne of the Options Industry Council. And today we'll be touching on basic options terms and concepts, contract terms of options, buying and selling options, pricing, and more. And after I introduce Joe, he'll then go over options trading, and then we'll have about 15 minutes of Q&A. Oops, let me just go back to the disclaimer I need to share real quick. The types of securities forms and research tools used in this webinar are for demonstration purposes only and should be not considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. And now to introduce our presenter, Joseph Burgoyne, the Director of Education and Business Development at the Options Industry Council. The OIC is the go-to resource for options education, and there Joe is responsible for supporting the educational programs, and he's also a staff instructor. Joe has spent over 30 years in the financial industry with over 20 on the floor at the Philadelphia Stock Exchange as an options specialist, where he was responsible for managing risk, making markets, and the development of proprietary database. So with that being said, I'll now let Joe take over and present us on options core concepts. Joe?
Scott, hello there. Let's share this. Okay.
Yep.
We're getting there, I think.
Yep.
How's that?
So far. Great. Disclaimer. All set.
All right. Away we go. Scott, thanks so much. And hi, everybody. Sorry for getting a little bit of a late start here, but let's get to it. It's always actually a lot of fun to talk to investors about the listed options product. As Scott said, I've been lucky enough to be in the industry for over 30 years in many different capacities, most of which really was spent on the floor of the Philex, as Scott said, for over 20 years. Had the opportunity to trade all kinds of option markets, which I find always to be a heck of a lot of fun. Scott went through his disclaimer, and certainly we'll find out how many of you currently do use options. I'm not sure, Scott. I'll go through a couple slides and maybe we can do that pop up. But I think what is important is that investors realize that options do involve risk and are not for everybody, but also I think the listed option market gets a terribly bad rap as being, too complex and too sophisticated, and that's where the options education comes in. The U.S. options market is comprised of 5 parent companies. Many of you, I'm sure, are familiar with CBOE, NASDAQ, BOX, the MIAX, and the New York Stock Exchange. They are, the 5 parent companies. A number of them have multiple exchanges. We have a total of 15 option exchanges in the U.S. at this point. Bottom left-hand corner, the OCC is, frankly, in my opinion, what sets our market apart. It is the contra side to take care of all counterparty risk in the listed options market. And then that's us on the right-hand side. Not sure how many of you are familiar with the OIC. We are the Options Industry Council, funded by the OCC. Our mission is just to get out there and educate investors, financial advisors, RIAs, and even some pension endowments and family offices with the responsible use of the listed options contract. So this slide to me is absolutely I like to think it's breathtaking. It's a snapshot of our industry. Started from nothing, bottom left-hand corner, in 1973 on the CBOE. First day back in April of that year, 16 companies had calls listed on them. I think we traded a little over 900 contracts that day. There were calls only because puts didn't even come into existence until the SEC finally approved them in 1977. So we started with calls only back in 73. And as you can see, actually I started down on the floor in Philly in 80. So, I was in the early days of the business. You can see where, option volume, those numbers on the left-hand side actually represent billions of contracts. So that 0.5 represents 500 million contracts. You can see it wasn't until the year 1999 that we actually got to doing 500 million contracts annually. If you go further over to the right side, you see 2011, the industry did north of 4.5 billion contracts. That year, there was a spike actually that summer, August of 2011, is the month the U.S. lost its AAA credit rating. And in that month alone, the industry did more than 500 million contracts. So we've come a heck of a long way since 73. You can see, in the volume chart here where things really took off in the late 90s, early 2000s. A couple things happened then. I think most importantly, all of us got electronic access to the listed options market. That was with the formation of the ISE, now owned by NASDAQ. We got electronic access to the market, and between 73 and 99, if you wanted to trade an individual option, on a security, you could only go to one of the 5 exchanges. That changed in 99. The various exchanges actually started dual listing Dell Computer, which had exclusively been on the PHLX. The exchanges started to dual list those markets, and within a number of months, everything was dual listed. So what happened, 99, 2000, we got a combination of electronic access to the markets, improved technologies, as well as more competition, where we had 5 marketplaces instead of 1, where you could buy and sell your calls and puts. Lo and behold, bid offer spreads narrowed, and you can see over the next 5 to 10 years, option volume absolutely exploded to the point where even despite what has been, up until the last 8 to 10 months, historically low, historic volatility in the marketplace, option volume has maintained steady levels north of 4.2, 4.3 billion contracts a year, which levels out to somewhere in the neighborhood of 16 to 17 million contracts traded a day. With the increased volatility, option volume this year in 2018 is averaging north of 20 million contracts a day. So, that's something about, where we've been as an industry. I just love the fact that we were nothing in 73, and over time here we've grown to the point where in 2018 we're doing over 20 million contracts a day. We've got north of 4,300 different underlyings. That's individual stocks, indexes, and ETFs, and also in excess of 950,000 strike prices. So lots of choices out there, but what's most important, and I hope that background on history was somewhat interesting to you. I love talking to people about where we've come from and where we are. What I think is important, especially for those of you who are just getting started, is a presentation like this, understanding the core concepts about listed options. And as I said earlier, I think the industry gets a bad rap with being too complex, too sophisticated, too risky. That frankly is just, if it's too sophisticated, it's because, you're taking it there. Many of the concepts we go through today are the core of understanding options. And there are lots of different resources out there. Scott's group at Regal, certainly they have, opportunities for education. We at our website, optionseducation.org, at the OIC, offer all kinds of courses, podcasts, email, learning, all kinds of different approaches. So, what we're going to talk about today, some of these core concepts, we'll define, what options are. We'll talk about, calls and puts and the types of options. We'll go through some contract terms. We'll be sure you understand, the whole idea of exercise and assignment. Sometimes that can be, a little bit nerve-wracking for people, but it should be pretty straightforward. We'll then talk about pricing with options, in the money, at the money, and out of the money options, and how they relate to option premium. And then, as Scott said, we'll have some time for your questions. So let's start by, defining what options are. Options are contracts, all right? So we got contracts between the buyer and the seller. Those contracts are, guaranteed by the OCC. So the buyer of the contract has the right to buy or sell the underlying asset, depending on whether you're buying a call or a put. The seller takes on an obligation, and that obligation, depending again, whether it's a call or a put, is to buy or sell the underlying. Of course, it's at a specific price, and we'll get into that, the all-important strike price, on or before a given date in the future. Buyers have rights, sellers have obligations. You're going to hear me say that more than a few times over the next 30 minutes or so. Buyers have rights, sellers have obligations. Again, the whole idea of complexity of the listed options product, to me, it's really straightforward. These are dynamic financial tools that can allow us basically to hedge a portfolio. We can generate additional income. We can use listed options to potentially acquire stock based on, what options we buy or sell. Some investors speculate with options too because of the leverage that each contract corresponds to 100 shares of the option. But by and large, we're talking about, financial tools that can be used for risk management, income generation, and stock acquisition. And, one of the great things about options is they offer a lot of flexibility, unlike, straight stock positions. On the left side, the long stock position, you make money to the upside. Obviously, you lose it to the downside. On the right side of the slide, basically a short stock position. Now, most investors generally aren't net short stock, before they're long stock. But, in the trading community, certainly pro traders, oftentimes, their net position will be short stock around long option positions. But in this world, you're making money to the upside if you're long stock, losing it to the downside. If you happen to be short stock, you make money to the downside, lose it to the upside. Very straightforward and one-dimensional. The thing about options, they offer lots of flexibility. And I think it's flexibility without having to get real complicated and complex. It's just a question of understanding these core concepts. Right here, there are 18 different types of option positions. If you look at the top right-hand corner, you can see the short straddle. I'm certainly not going to go through all these different positions. The point here, as you move along in your options education, hopefully when you put on a position, you'll be able to envision, basically in your head, something like that top right-hand corner, the short straddle. You're going to know, as the stock goes up, whether you're making or losing money, and as the stock goes down, whether you're making or losing money, and whether or not you've got defined risk. In a short straddle situation, there's unlimited risk. And so that's taking it a step further in terms of applying the upside and downside risk to a particular strategy. Maybe in future webinars with Scott and the gang at Regal, we'll get into specific different option strategies and their risks. So let's talk calls and puts. Two types of options. We've got calls, we've got puts. They're basically on individual companies, ETFs, and indexes. As I think many of you know, each contract corresponds to 100 shares of the underlying index, or ETF. So we talked about rights and obligations. Equity call buyers have the right to buy that underlying stock or ETF. The lingo in the industry is often, I'm long the call or I'm a holder of the call. The equity seller, on the other hand, takes on the obligation to sell the underlying stock, index, or ETF. And that lingo is being short or actually the writer of the option. That's on the call side. On the put side, and for those of you who are new, I would just urge you to be patient. This stuff can be confusing. I don't think it's necessarily complex, but it can be confusing. On the call side, the call buyer has the right to buy the underlying. The call seller takes on the obligation to sell the underlying. Now, on the put side, the put buyer has the right, or he buys the right, to actually sell the underlying stock, index, or ETF. Again, long or the holder of that put. Now, equity put sellers take on the obligation to potentially buy the stock. All right, so call buyers have the right to buy the underlying. Call sellers take on the obligation to potentially sell the underlying. Put buyers take on the right to sell the underlying index, stock, or ETF. And then put sellers take on the obligation to potentially buy the underlying stock, index, or ETF. 4 real keys. Again, option contracts give the call buyer the right to buy the underlying. They give the put buyer the right to sell the underlying. The call seller has an obligation to sell the underlying, and the put seller takes on the obligation to buy the underlying. And for each contract, we're talking about 100 shares of the underlying at the all-important strike price at any time before expiration. Okay, so calls and puts, rights and obligations, core concepts for moving forward here. So each contract has specific terms as well. Let's go through some of them. Each standardized contract has the underlying stock, index, or ETF. You've got the unit of trade, which almost always is 100 shares of that underlying. You've got the strike or exercise price, and then you've got an expiration date. So let's take a look at an example with the different components. We'll use XYZ at OIC. Actually, XYZ is always our favorite underlying. We've got the Jan 17. It's actually the call in the year 2020. It's the 45 call. That's the strike at $2.50. So the underlying is going to be XYZ, typically 100 shares. The expiration date, as we mentioned, is January 17th of 2020. So we've got the underlying at XYZ, the expiration date, Jan 17 of 2020. The strike or exercise price is the 45 call. So the strike is the price at which the underlying can be bought or sold, depending on whether you've been a buyer or seller of the call or put. Okay, so that's the 45 call. And then the price or the premium is $2.50. And the way that works, each contract, since it corresponds to 100 shares of the underlying, you take that premium of $2.50 and you got to multiply it by 100. So each contract corresponds to a value of $250. And that's potentially where the income generation comes in. So we talked about rights and obligations, and that leads us right into this whole idea of exercise and assignment. So the buyer has the right to buy the underlying if it's a call, or to sell the underlying if it's a put, 100 shares of the underlying at the strike price if he or she exercises the long contract. And then to exercise, basically, the way it works, we go back to the $45 example. If the underlying stock closes at $45.01 or higher, and you are long the contract, you will automatically be exercised. So if you were long the call, say one call of the 45s, you'd then, after expiration, rather than be long the call, you'd be long 100 shares of the underlying. So as the slide says, only buyers can exercise the option contract. Buyers, they purchase rights and have the ability to, buy the underlying or sell the underlying, depending on whether they're, buying calls or selling puts. Okay, but option buyers are the ones who can exercise the option contract. Option sellers take on that obligation, and that obligation is potentially to sell the underlying if you've sold a call, or to buy the underlying if you've sold a put, 100 shares for each contract at the strike price if you're assigned. An assignment is when that option that you're short, has value or is in the money at expiration. That's when you get assigned. So buyers have rights. That right is, potentially to exercise the contracts. Sellers take on obligations because they're collecting cash, and they can be exercised, or they can be assigned at any time up to expiration. So different types of exercise styles. You've got the American style contract. The vast majority of those 4,300 plus underlyings that I talked about have American style contracts, which means you can exercise any time up to the point of expiration. All right. So the long can exercise at any time. The short side can be assigned at any time. And I'll talk us through a little bit when we get to premiums, when it's likely that you will be assigned and when the long contract may be exercised. They're American style contracts. Again, exercise or assignment anytime right up to expiration. European contracts, on the other hand, are typically index contracts, and they can only be exercised and therefore assigned at expiration. And many of these contracts, these indexes, expire on the third Friday of the month for the monthly contracts. There are a number of weeklies actually that have come to the market in the last couple of years. So, they could be assigned on those dates as well. When you're talking about the indexes and the European settlements, you got to really do your homework to know exactly when expiration is. In terms of the type of settlement, you can settle in stock, where, if you may, be long a contract, you're going to then be long stock. If you're short a contract, you may potentially have to deliver stock and be short stock. So there's the physical stock delivery on the long and short side. There are also different, typically, indexes that don't settle in the underlying stock, but settle in cash. So again, that's actually where a lot of the detail comes in, knowing, whether it's an American or a European type of contract, and then the ramifications for each, whether they settle in the physical security or cash. And you can get that, certainly, those kinds of answers, if not right online, through Regal, but, talking to some of their support group. So let's talk a little bit about pricing, and we'll just keep it high level, because this is, a presentation on core concepts. We've talked calls and puts, rights and obligations. It's important to know, the right of the call buyer, the put buyer, the obligation of the call seller and the put seller. Let's talk a little bit about, the different types of options that are out there in terms of in the money, at the money, and out of the money. So right here, you can see highlighted in yellow, we got a stock that's priced at $50. And around that, we've got 40 calls, 45 calls, 50 calls, 55 and 60 calls. So the calls that are in the money, the calls that are in the money are the strikes that are below the stock price. So with the stock price at 50, we're talking about 45 and 40 calls. For those of you who are new, it may be mumbo jumbo to you. If you're in the options, space already, this may make perfect sense. The 45 call represents the right to buy stock at 45. The 40 call represents the right to buy stock at 40. Well, if the stock's 50 and you can buy it at 45 or 40, well, there is an in the money value there. The in the money value for the 45 calls would obviously be $5, and it's $10 for the 40 calls. So you know that those 45 calls are going to have a value of at least $5, because again, you're buying the right to buy stock at 45. If the stock's 50, there's $5 of in the money value there, plus whatever the value of time is. And as we know, options, can expire, within a week, or they could go out, as long as 2 or 3 years, depending on, whether you get into a leap option, which is a longer dated option. So that's, they're the in the money calls. The 40 calls with the stock 50 have a value of $10. That in the money or intrinsic value plus time value. The 45s have that $5 value, plus whatever time is. So they're in the money calls. At the money calls, the stock price is 50. The right to buy stock at 50 is at the money. Same as the strike price. Clearly, no intrinsic or in the money amount. And then the out of the money calls, the right to buy stock at 55 or 60 with the stock at 50, they're the out of the money calls. Well, why would somebody even care about buying a 60 call with a stock at 50? Well, that 60 call would give somebody the right to buy stock at 60, and maybe that right wouldn't cost a whole heck of a lot of money. And, maybe it's a bull market. Maybe there's, crazy news on the stock, and maybe somebody was lucky enough to have that $50 stock go to 70. Well, if it went to 70 and you had a 60 call, that call would then be worth $10 plus whatever time value was left. So that's why there's so many strikes around the price of the stock, because, things do happen. So that's the call side, in the money, at the money, and out of the money. In terms of the puts, we got to flip it around. And that's why, as I said earlier, sometimes, the option core concepts, especially when you start talking puts, can be a little confusing, but not necessarily complex. I often find that investors just have to go back to it a couple times and then it clicks. On the put side, again, we're talking about our $50 put. So what does the put represent? The put represents the right to sell the underlying, where the call represents the right to buy the underlying. The put represents the right to sell the underlying. So that 60 put represents the right to sell stock at 60. If the stock's 50, you're going to have $10 of value there plus time. The 55 puts are going to be worth $5 with the stock at 50 plus time. So you can see the 60 and 55s are both in the money options. Just like on the call side, that at the money put option is going to be that strike that's right about the same price of the stock. So those 50 puts represent, on the buy side, the right to sell stock at $50. And then, opposite of the calls, the out of the money puts are going to be the lower price strikes. So the 45 and 40 put, again, that 45 put on the buy side represents the right to sell stock at 45. The 40 put represents the right to sell stock at 40. So those puts, the terminology there would be they're out of the money. So that's calls and puts, in the money, at the money, and out of the money. If you can combine that, with, and again, that in the money amount corresponds to the intrinsic value. You've got intrinsic value and time value for the in-the-money calls and puts. The at-the-money and out-of-the-money calls and puts only have time value. So how about if our listeners, Scott, we try a little bit of a quickie quiz here on the in and outs. So stock price 55, is the 65 call in, at, or out of the money? I hope you said out. $10 out of the money. You got the stock price 55, that 65 call represents the right to buy stock at 65, but that's $10 above the price of the stock, so it's $10 out of the money. How about a 77 stock price, 70 call? In by 7. I hope you get that. Right to buy stock at 70 with a stock 77. Value of that call is going to be $7 plus whatever time is left. How about the $63 stock price with a 70 put? Hopefully you said in. Right to sell stock at 70 with a stock 63, in the money by $7. $51 stock price with the 45 put, in or out? Out by $6. 45 strike, the right to sell stock at 45 with the stock at 51, $6 out of the money. And how about these 22.55 stock price with the 22.50 calls? In the money by 5 cents. Okay, in the money by 5 cents. So I hope that makes sense to you. For those of you who are just getting started, maybe a little challenging, but for those of you who are in the option space, no problem at all, I'm sure. So I talked about this a little bit just in terms of the premium. So, the buyers of calls and puts, they have rights. Well, rights don't come for free. They pay the premium. Sellers take on those obligations I talked about, sellers of calls and puts. And again, please, know cold exactly what those obligations are. The call seller potentially has to sell the stock. The put seller potentially has to buy the stock. And I say potentially because it depends, if they hold those short option positions, it depends where the price of the stock is at expiration, whether they're actually going to have to deliver on that obligation or whether those options will go out with no value and therefore they will collect the premium. So that's oftentimes the motivation for option sellers. They want to collect the premium. You just have to be aware of what are the risks associated with selling particular options. So buyers pay premiums, sellers collect premiums. Again, each contract corresponds to 100 shares of the underlying. That's really where the money comes in. So if the contract is quoted at $3, the value of each and every contract will be $300, ex commissions. So I've mentioned this in the money or intrinsic value amount. So only the in the money calls and puts have an in the money amount or intrinsic value. The majority of options are either at the money or out of the money. So they don't have that in the money value or intrinsic value. They just have time value. And that's important to be aware of. And of course, options, as they get closer to expiration, that time value is eroding. That's where, again, if you're short an option, that time value may be working your way, depending on how much the underlying stock is moving. If you happen to be long, contracts and long premium, and the stock isn't moving, the value of those options is going to erode and it's going to cost you some money. And options at expiration are only worth whatever that in the money amount is. So if the contracts are not in the money, there's no value and there's no reason to exercise those contracts. So just to go through it a little bit, you got, your option premium. You may have intrinsic value, and that intrinsic value is going to be a combination of the stock price versus the strike price. To have intrinsic value, there's always going to be an in the money amount. The other factor is the time value. So you've got time, volatility. It's hard to believe I've been talking for 20 minutes in the option space here and haven't talked about volatility, but we're talking core concepts. But volatility, the amount of movement in that underlying, certainly will go a long way in defining how high or low that option premium is, the value of time. Other pricing factors that get thrown into the pricing models are, interest rates, dividends, if a company pays them. But that's the combination. You may have intrinsic value, and then you will have time value. And oftentimes, depending on how volatile a stock is, that time value may be inexpensive or more towards, or more valuable and more expensive because the stock moves around a lot. That's one of the key factors. So again, in the money calls and puts do have intrinsic value, and they may have time value. I mean, depending on how deep in the money those calls or puts are, may minimize the amount of time value. The other factor is how much time is there actually until expiration. So in the money calls and puts definitely have intrinsic value, and then they may or may not have time value. At the money calls and puts, as well as out of the money calls and puts, no intrinsic value because they're not in the money. So they will not have the in the money or intrinsic value, but they will have value, and all of that is time value. Now, if expiration's tomorrow and the caller puts out of the money, there may actually not be any value to that, but those that have some time value in terms of actual timed expiration likely will have this time value component still left in them. So you've got intrinsic value and time value in each of your option prices. Quick example, XYZ, $53 a share. The Jan 50 call, what does that represent? The Jan 50 represents the right to buy or sell stock at $50. The value of that call is $5.20. So let's think about that. You've got the stock at 53, the Jan 50 call is $5.20. Do we have any in the money amount here? I hope you said yes. $3 of intrinsic or in the money value, but the total value is $5.20. That leaves us with $2.20 of time value. All right. So again, this is an example where we had some in the money value or intrinsic value. The 50 call with the stock 53 has a $3 intrinsic value, total value $5.20. So you've got an additional $2.20 in time value. How about, okay, again, stock's $53 here. So what about the 60 call? Is that 60 call going to be in or out of the money? Well, it's the right to buy stock at 60 with the stock 53. It's going to be $7 out of the money. But if it trades for $2.10, how much intrinsic value? Well, if it's out of the money, there's no intrinsic value. So all of that $2.10 would be time value. So that's option premiums, intrinsic value, and time value. You can think about these concepts both for calls and puts the same way. So one more quiz, Scott, I think before maybe we turn it back in, we take some questions. Let's start with the stock price at 77, the 70 call. I think we had this one before. It was in the money. The option premium here is $10.50. So we know that's the right to buy stock at 70 with a stock 77. We know we've got an in the money value of $7. And then that time value is going to be $3.50 because the total value of the contract is $10.50. I hope that makes sense to you. Next one, stock 50, 58.50, the 60 put, in or out of the money, total value $3.75. And this is where I get back to so much of option contracts, option concepts can be simple math, which is exactly what this is here. If we get that the 60 put is the right to sell stock at 60, the stock's 58.50, so boom, we know that's in the money. It's in the money by $1.50. Then you get into the simple math. The value of the option is $3.75 minus the $1.50. leaves us with 225 of time value. So that's straightforward. $83 stock price, 85 call. Tell me out of the money, please. If it's out of the money, there's no intrinsic value. So the time value's the entire value of the option, which is 225. And lastly, we've got 1250 with the 1250 call. Pretty straightforward. It sounded like it may be at the money. You got $1.50 of value, so there you go. All $1.50 is time value with no intrinsic value. So I hope that makes sense to you. Before I turn to Scott, just a couple things just to mention to you. If you're not familiar with the OIC, we've been around actually for 25, going on 26 years. We're founded in 1992 after the crash of '87. Took a few years, but the industry leaders decided, we got to get people to understand what these rights and obligations are all about and how these option contracts work. So we've been out on the street really for 25 years. I've been lucky enough to be part of OIC for 9.5 years. A couple things really you should know about it, especially if you're just getting started. As I said, Scott and the gang at Regal, they do a nice job on the education side. At OIC, that's all we do. Go to our website, optionseducation.org. Look for My Path. If you can't find it, plug it into the search bar. You'll take a 20-question assessment test, and with that, we'll grade you. You'll be either a beginner, intermediate, or advanced, and with that, we will download lessons for you. That will reinforce some of the core concepts that I've talked about today. And it's a great free way to build a base of knowledge. Additionally, we've got podcasts, webinars like we're offering today. We do 2 a month, all kinds of things out there. So check us out at optionseducation.org. And with that, Scott, I think I would turn it back to you.
Thanks a lot, Joe. This was really great information. I think it gives a really good foundation for those who are just starting out in options and never traded before, or those who just need a refresher. A lot of good kickoff information here. And we do have a couple questions to get to, and we also encourage our audience to submit questions, and we'll try to get to as many as we can. And actually, I'm just curious. I have a question for the audience. There's a chat box there. How many have traded options before? And if you can answer, just put a yes or a no in the chat box. That'll give us an idea of how many have traded options before versus how many want. Okay. So I'm looking at the chat now. It's like maybe 80% have traded options before, just based on these results coming in. So very, very interesting. Just a couple questions for you, Joe. Is it better just trade calls and puts individually, or are spreads a better way to trade?
Oh, okay, good question. And with 80% already into options, as you said, Scott, much of this I'm sure was just kind of a review for folks, but I want to thank you for tuning in. Individual calls and puts versus spreads. Personally, I'm a spread person, but I would suggest if you're just starting, what's really important is to actually make a trade, because you learn so fast. I mean, you can study, do your homework, but once you actually, put on a trade and see the dynamics of the market, it's a different learning curve. And sure, you could start by doing maybe a vertical call spread. If you went spread and by vertical call, let's say we've got XYZ, it's $50. You think it's going to 55? Maybe you'd buy a 50 call and, sell maybe a 55 call. If you've got, strikes that are more narrow, maybe you'd buy a 50 and sell a 53, something like that. So that, and by buying one, selling another, the reason I like spreads is because it does hedge your risk. So for me personally, it's spread first. But if you are just starting out, you may not understand, the concept of spreads or know which spread you want to do. And I hope, Scott, we'll have an opportunity as we go forward to maybe do a few more of these. And as I mentioned earlier, we'll get into maybe some risk management techniques and some spreading ideas. But if you're going to just buy a call or buy a put, I would say, do it, but, try not to spend too much money on it, or don't do a lot of contracts. It's a key mistake that a lot of investors do frequently is they put on too big a position. So if you're just starting out, I would say, I would urge you actually make a trade, but make one that maybe doesn't have, too much dollar commitment tied to it.
Yeah, and to follow up with what you just mentioned a little bit ago, Joe, yeah, we definitely plan on offering more webinars to build on this educational content that you're providing, to build on this foundation so people can continue their education and get more comfortable with trading options. We got a question, can anybody trade options, or is there an approval process for it?
Well, do you want to answer that, Scott?
Well, I would say call your broker, your individual broker, or I'll share some contact information at the end if you don't have an account with Regal Securities. So you can call in and get all that information.
And I think what I would just add there,
Joe.
Scott, and maybe what somebody was getting at is depending on your, there are different levels. I think there are 5, 6, or 7 different approval levels. In order to trade spreads, you need a certain approval level. So that's the thing. You want to be sure that you know the rules of your broker, and then talk to them. And not a big deal to get approved, but in certain situations, you need different levels of approval.
Great. What is an ideal dollar amount for a beginner or contract? From Tom.
I'll tell you, my answer so frequently to investors is it depends. And the reason that is, if you happen to be an extremely wealthy investor, the answer to that question is far different, unfortunately. And it shouldn't necessarily be that way, but I think it is because, a wealthy investor could afford to lose more than maybe somebody who didn't have as much capital. So I would say a good amount would be an amount that you felt you could afford to lose and not stay up at night. So that would be, and you can, talk about like an at the money call or put, depending on how much a stock moves. You can find them at all different price points. Again, volatility will be a factor in that, but I think it gets back to, and this really gets back to something I didn't talk about today. As we all maybe advance in our options journey knowledge, we got to know what kind of investor we are. Are we risk averse, or do we like risk? I mean, is having an option position or any, investment position on, is it like an adrenaline rush for you, as opposed to, a solid core investment? So you really need to know what type of investor you are. And then to get back to Tom's question, make sure you're not risking more money than you can, than is going to then allow you to sleep well at night.
Great. Lucy asks, do you offer paper trading? The answer is yes. And Lucy, depending on what broker you want to start with, just reach out to support@regalsecurities.com. We'll help you get set up. I'll share that contact information again at the end. Another question is, will this webinar be posted online? Yes, it will. It will actually be shared with you over email. So this is being recorded, and if you've registered, we'll send a link to watch this webinar again. Susan asks, how much money do you need in your account to sell naked puts? Again, if there's minimum amounts for your broker, I'd contact your broker to ask. But Joe, do you have anything else to add as far as how much money you need in your account to sell naked puts?
Yeah, well, first of all, you have to go through the approval process, but there are 2 approaches to selling puts. And let's remember, when you sell put, what is the obligation? So whenever you sell an option, you're taking on an obligation. And on the put side, it is, if you're a put seller and that put is in the money at expiration and you haven't covered the position, then your obligation is to buy the stock. So let's say, you sell a $50 put on a stock that's trading, let's say the stock's trading at 55. You like the stock, but you don't like paying 55 for it. You want to try to buy it at 50 or less, and you think, the stock may come back. So you sell a 50 put. Let's say you sell it for $2. And, it doesn't, let's say, two examples. So, we sell a 2-month put. At expiration, the stock closes at 51. And so what happens to that put? It expires worthless, and you've collected $200 for each put you sold. Taking it a step further, maybe the point was not to sell the put to generate income, but you actually wanted to buy the stock. And the stock, went from 55 to 48. So at expiration, the stock's at 48. Your motivation was to buy the stock. So you're actually going to have to buy the stock if you don't close the put position. By close, I mean buy it back to, neutralize it out. So at 48, unless, the client is working on margin, you would have to have up $4,800 in order to buy that stock. So that would be the amount of money you need to take on that short put position, the cash secured put.
Okay, we just have a few more minutes, Joe. How do I know if I'm going to get assigned?
It's a great question, and I think it's one that, people actually fear. They have an anxiety about getting assigned, but I would say 98, 99% of the time, when it's going to happen. And it happens really 2 times only. I mean, there are rare exceptions. I was on the floor for over 20 years. Less than 10 times did I get assigned when I didn't expect to get assigned. And if you get assigned by accident, basically the owner of the option just exercised at the wrong time and you collected your premium faster. But in terms of when can you expect to be assigned, two main times. Number one, when your option only has intrinsic value and there's no time value left. If there's no time value left, the owner of that option may decide, and you can't ever know, the buyer's motivation, but they may decide just to exercise. If there was, intrinsic value and time premium, it would make no sense to exercise, because if they exercise, they'd be giving up that additional time premium component. They'd be better off selling the option in the open market. So when there's no time premium left in the contract, you can expect to be exercised, or assigned rather. And then the other time is, and this is where people get confused sometimes, as we get to a dividend, if the time premium component of the options contract, okay, the time premium component, of course it has to be in the money. If the time premium component is less than the dividend that's going to be paid, you can expect to be assigned. So they're the 2 reasons, 99 out of 100 times, when you can expect to be assigned.
Okay, and if there's any last-minute questions, please submit now. Dave asks, if my option is in the money after expiration, what happens?
Okay, let's take the example of a long call. As I said earlier, if you are a penny in the money, so let's say the stock's 50 and the stock closes at $50.01. If you're long the 50 call, you will take delivery of 100 shares of stock for every contract you're long. And by taking delivery, you've then got to put up capital for that long stock. And if it's a $50 stock, you got to put up $5,000. And that's where the management of the option positions at and right after expiration comes into play. Your capital requirements, and more importantly, your risks often change dramatically after expiration if you exercise. All right, so that's on the call side. On the put side, if you were long a put and it was in the money, you know, you might turn out to be short stock, which, you know, most investors have no interest in actually being short stock after expiration. So it's just something you have to pay attention to. If you want to avoid, you know, you just sell out the contract and net it out and you'll have no position.
Great. And one last question from Jen is, do I need to put up more capital if I exercise my options?
Well, it depends really, Jen, with your agreement with your broker. And that's really what it comes down to. If you, you know, were long calls on the cash secure put side, just like the name of the strategy, you know, the obligation is already cash secured if you've sold puts. You've put the capital in your account. On the long call side, not necessarily the case. But if you go from, you know, being long a call that's worth $1, say you're long one of them, that's $100, you know, you may have to turn around and then, you know, get long this $50 stock and have to put up, you know, $500 or $5,000, depending on how many calls you're long. So, you know, it's just something you have to certainly talk to your broker about. And back to the core concept, know the rights and know the obligations. And what you're talking about, Jen, is your obligation for capital after expiration.
Great. And that's all the time we have for today for the Q&A. So thanks again so much, Joe. It's Joseph Burgoyne at the Options Industry Council. This was great kickoff content to options trading. We will be having more webinars on options trading. So be on the lookout in your next email. Let me just get the final, let's see here. Got the final slide for you with contact information. Once again, there's Joseph. Yeah, thanks everybody for attending. And if you have any questions and you have a brokerage account, please reach out to your support team. We'll be happy to address any more of your questions. If you're looking to start an account, please reach out to support@regalsecurities.com or call 1-800-92-REGAL. We did have a question one last question was squeezed in by Susan. Does your company teach the various spreads? We actually do have a recent webinar on that, Susan. If you reach out to us, we can share that with you directly. Actually, when we have the recording of this, we'll point it out on because all of our recordings are on our website. And so we'll be sharing that over the email. We'll be following up with everybody. And then our next webinar with the Options Industry Council is going to be a month from now in mid-August, Wednesday, August 15th. We'll keep everybody updated on the topic, and registration will be required for that one as well. So we hope to see you there, and hopefully this was beneficial for you today. Once again, give us an outreach if you have any questions, and we'll be happy to address them. And thanks everyone again for attending. Have a great rest of the day. Bye-bye.